Real Estate Insider, where America goes for funding. Appreciate all of you guys for tuning in and watching the show and the channel with Angelo Christian. So every Thursday we do our talk with Angelo live. You got to get to tune in, check in, and see what's going on with the market, the world, with real estate, finance, credit. We talk about all that stuff. We do nationwide commercial and residential lending. So definitely want to discuss that with you guys and kind of give you the market update for the week. And obviously, if you all have any questions, feel free to um, ask those questions down below. I'll be talking about the things that's on my mind for the week, kind of what I'm seeing, and you guys can discuss what you guys want to bring up too. So it's all good. So um, so the things I'm going to be talking about tonight is closing a property in your LLC. And if you have one, then you shouldn't be closing in your personal name. That's number one. Number two is the rule of four. I want to make sure you guys are aware of what the rule of four is. No doc loans, number three, is the third thing that I want to kind of go over. Number four is doing a soft credit check. Why you need to be looking at doing a soft credit check if you're talking to your lender versus doing a hard credit check to start the process. So, and then the other thing that I want to talk about is the quit claim deed. Whenever you're transferring properties and title, no seasoning. So those are the 5 things I'm going to be discussing tonight. And if you, like I said, if you guys have any questions, feel free to ask me those questions down below. The first thing is that if you're closing a property in LLC, that's a really good strategy. And I would say if you have an LLC, not to close one in your personal name. It makes a lot more sense to close in your LLC because, when you close an LLC, it doesn't report to your personal credit. You're protected from legal, liability, and there's a lot of, positives to that. Maybe you don't want to report that debt on your credit. Okay, maybe you just want to have it on your, private, and you don't want to disclose that. You might be trying to get another loan, or you might be trying to do something else, and you want to separate that loan, that property, that loan from your personal credit and your business credit. So having an LLC and using your EIN number makes a lot more sense. And then also from the legal side too, if you get sued and people come after your assets or something happens to your tenant, he tries to sue you, they can just sue that LLC, and that LLC could just be, just hold that property and not have any of their assets. Versus if they sue you personally, then they can come after all of your assets, right? So there's a lot of reasons why you'd want to close in an LLC versus your personal name. So I highly recommend that if you're looking to acquire rental properties, investment properties, I don't care what it is, single family, multifamily, that you put those in an LLC. And there's a lot of different type of LLCs. There's your traditional LLC. There's a series LLC that you can use. That's basically a branch of LLCs that you can put all your properties in. And that makes a lot of sense because it shields you from, a lot of protection in case any issues arise. And we do all those type of loans. Like we do, LLC loans, full recourse loans, non-recourse, hard money, no doc, investor cash flow, DSCR, fix and flip, short-term rentals, ground-up construction for investors, all different types of financing programs. So, hey, Brian, thank you, brother, for watching, man. Appreciate you for tuning in. So, so you have all these different type of programs that are out there. And the thing is that with private loans, you can accumulate as many rental properties as you want. So a lot of my clients, they start with one property and then they add, slowly many properties over the years. There's no limit on the commercial side, private loans, on how many you can get. Like on the Fannie Mae, Freddie Mac side, you're limited to 10 properties. Here you can get as many as you want. And we do Fannie Mae and Freddie Mac too. We have nothing against that. I'm just saying that it depends on what your goals are. If you want to build a very large portfolio, you're going to have to go beyond residential and conventional loans and go into, portfolio type products because you're probably going to want more than 10 properties. So the other thing with conventional loans is they're very stringent on the underwriting which is okay if you qualify for it. But if you don't qualify for it, then you're going to want to look at a different product. So that's kind of the biggest benefits of using an LLC. I'm a big advocate of it. Now, obviously, just depending on what you're trying to do. Um, the thing is that a few things you need to know about closing LLC, that whoever's on the LLC, um, and depends on the lender and the product that we're doing. The percentage of ownership that the members have will determine if they have to sign on the loan or not. Because obviously, you need a human being, a person, to sign on the loan. So let's say you have two partners, one partner is 50-50, and one guy's got a 500 credit score, another guy's got a 750. That could be a problem for the loan because, the one guy's got a 500. Now, if the partners are like 95-5, meaning one guy owes 95% and the other guy owes on 5%, and he's the one with a 500 credit score, then it may not matter what the guy with the 500 credit score has because he's got such a low ownership of the business. So these are things you have to think about when you're doing a loan. They get very technical. They can get really complicated. That's why you want to deal with an expert that knows what's going on, so they can help you to figure out the loan and get it done. Okay. So, but yeah, the biggest thing I'd say that those are going to be the major advantages to getting a loan in an LLC versus just doing it in your personal name. So that's that. So the other thing I kind of want to shift is the second thing I want to talk about tonight is this rule of four. We've talked about this a lot on the channel, and basically, hey Kim, if you need a cosigner and you don't have one, it depends on the type of loan that you're doing. Cosigner is pretty much allowed on every loan except USDA and VA. So like conventional FHA, um, you know, hard money, you can use a cosigner. But the cosigner, the thing is that with them is the benefit of using them is to use their piggyback off their credit or their income to help you to qualify for the loan. So if they have a higher credit score or more income, then they can help. Like I'll give you an example. Let's say a person gets approved on their own for 500,000, and they say, no, I need more than that. I need 1 million. Well, that's when you'd want to bring in a cosigner because the cosigner can help to boost up, your qualification. Now the thing is that the cosigner, they go on the loan, they go on the title with you, so they're legally an owner, and go on the loan with you. Now they can be taken off the loan in the future after 6 months if you want to take the cosigner off. Because sometimes the cosigner is like, well, look, I want to go and get my own property one day, and that's fine, and they can do that. Um, the other thing too about the cosigner is like if they're not actually living in the property, it's a non-occupant cosigner, and you're the one actually making the payments as the borrower, then they can still be free to go and purchase another property because it's not really in their debt ratio if you're the one making the payments. Okay. Now, but if they're making the payments, they can't be taken out of their debt ratio. Um, let me look at your specific case, and I'll message you. So I'll take a look at it and see. We'll take a look tonight or this weekend to see what you got. I'll look at your. Hey Brian, on the FHA down. Okay, I'll take a look and I'll message you, Kim. Thank you. Um, hey Brian, I think I saw your question on FHA down payment assistance. There's no income restrictions, so you can make as much as whatever. And then there's no location restriction. There's loan limit restrictions. The loan limit's based on the county, anywhere from 500,000 to a million. It does require 620 or higher middle score. You have to verify income for the last 2 years. Your debt to income ratio can't exceed 55%. So those are the main requirements. So I don't know if that answers the question or not. So yeah, there's no income limit, and you don't have to be a first-time buyer. You can get up to 5% for down payment and closing cost assistance. So if you buy a $500,000 house, you can get 25 grand to contribute towards your down payment and closing costs. So it's a really strong program. Oh, okay. I'm seeing. Okay, I'm reading what you're saying now. Um, well, yeah. So if the loan limit is 644 and the purchase price is 680, if I read that correctly, then you do the 680 purchase price, and then now depending on, like, if you're doing an FHA loan, the FHA loan is 3.5% down. So you can use that 5% towards down payment and closing costs. So you could take, for example, if it's 680, you could take the 5% and apply that towards the down payment to get to the loan limit. Now you obviously have closing costs on top of that, so it's 5% total, down payment and closing cost assistance. So if you use the 5% towards the purchase price, then you're not going to have anything left over from this product for the closing costs, which could be okay. I'm just letting you know. And then you might have to pay your own closing costs or have the seller pay the closing costs. But yes, you can use the down payment assistance program to apply towards that 680 price to get the purchase price or the loan to get it below the loan limit. Yes, you can. If that part is yes, you can. So, because if you got 680 at 5%, that's what 30, 8 times 5, 34,000 towards down payment. So you're at 646, I guess, right? So 646 loan amount. So you could, yeah, yeah. Yeah, that's a good question though. So anyway, going back to the rule of four. Now the rule of four is just a, standard back of the envelope. Yes, we can help with the credit too, Kim. Kim's asking, can you help with the credit? Yes, we can help with the credit. We have a credit team that can help you, and we can take a look at that for you to help you out. So the rule of four is a good rule. Now, I know that it's not going to apply in every situation, especially in a market that we're in right now with inflation. And I'm just, putting it out there to kind of tell you what the rule of four is. Now, I mean, does it mean that, you got to live by it or do it? I mean, you just got to do I mean, my thought is you got to do whatever you can to make it work. And basically what it means, the rule of four, is, whatever your income is, then you multiply that by 4 to, determine how much you can qualify for the house. Okay. So if you make 50 grand a year, you multiply that times 4, that equals 200,000. And that's what most lenders say that you can use to purchase a house. So if you make 100,000 a year, You could purchase, a $400,000 house. You make $1 million a year, you could purchase a $4 million house, and so on and so forth. So now, um, like I said, I don't agree with that 100% because there's areas that they're very expensive, and you're not going to be able to do that. And also, you have rising home prices, rising rates. So in some parts, it's not going to really be practical. Some people, the rule of two is more like the real situation. So if you earn, 50,000, you're buying, a $300,000 house, $250,000 house. So, which makes it like the rule of five, a rule of six, because home prices have risen so much, and really, it's really hard to be able to find a property that that you can purchase for a reasonable price that's livable, and that makes sense. There's not a lot of inventory out there. So just know that that's what the rule of four is. Um, so basically, whatever your income is, multiply that by four, and that's what lenders say that you can purchase on a house. I think it's kind of tough to do a little bit. You know, I mean, I agree that you don't want to be house poor, and I'm not trying to say that. I just think that it's hard to make that work in reality. So, um, but you never know. Maybe you can make it work. So I think more like the more realistically, the rule of five I think is probably more realistic in today's environment. So the rule of six is probably too. Thank you, Kim. I agree with you. Where there's a will, there's a way. Hey, listen, I'll say this, that if you really want to do something, you'll figure out a way how to do it. If you don't want to do something, you're going to find an excuse, right? I've always believed that. Marco says, if I get a first lien HELOC on my house, how long do I have to wait to apply for a mortgage? Uh, 6 months, Marco. You have to wait 6 months. And you can do a first lien HELOC on your primary residence. You can do it on your second home. You can also do it on an investment property. And you can do, we have a no documentation HELOC and obviously a first lien, full documentation. But we have second lien HELOCs up to 400,000, no documentation for your primary or investment or second home. But the maximum is 400,000 on that one. The full documentation you can go up to 2 million. But it's a really, really good loan program too. I think if you can get rid of your mortgage and replace it with a line of credit, it's a no-brainer. Obviously, if things make sense. And what I mean by that, if things make sense, if you got a 2% rate on your first mortgage, you're probably not going to want to pay that off for a first lien HELOC at 7%. You can do a second lien HELOC, leave the first lien there. That makes more sense, right? Because then you can leave the first lien in position and then do a second one behind it. That's okay. I mean, that's a good idea. That's why we have the second lien HELOC too. Um, so, and that's one thing that also that's the other thing I want to talk about is doing a soft credit check versus a hard check. When you talk to a lender, they shouldn't be doing a hard credit check on you in the beginning because the soft credit check has the same scores as the hard check. So there's really no reason for someone before you've even talked about terms or loan approvals why they're doing a hard check on you. It doesn't make any sense. you're far better off. I wouldn't even do a loan with somebody if they're doing a hard check on me in the beginning. You should be doing a soft check. And with that, um, this should be fine. You don't need to do a hard credit check in the beginning. We're way too advanced as a economy for people to be doing a hard check on somebody. Why? Because it does affect your credit score. It does lower it, affects your points. It stays on your credit for 2 years. It's not necessary. You can do a soft check. We do soft checks, and the score is the exact same thing as a hard check. So why would somebody do a hard check? Matt, what's the easiest loan to get? It depends, man. It depends on what you're trying to do. There's trade-offs to everything, right? Like there's, no doc asset-based loans are easy to get from the qualifications, but they're more expensive. You're going to pay more interest. You're going to pay more closing costs, and sometimes that makes sense. Sometimes it doesn't. Obviously nobody wants to pay more interest. It doesn't. Of course, nobody wants to do that, but sometimes they have to. They may not be ready. A lot of people that I see, they don't know, and it's of course they don't know because it's not your industry, it's not your space. You don't know what the qualifications are, and you see something online, and unfortunately, it's just not the reality. So you think that, okay, I'm getting this rate or I get this down payment, and then you find out, oh man, I don't qualify for that, or it's not real or whatever. So you got to just look and see what you're trying to do, and because like if you're trying to buy your house to live in, you're going to want the cheapest payment possible. And now I'll say this, that you may not be ready for it at that time, but we can show you a way and guide you on how to qualify for that loan to get the cheapest payment, to get the cheapest rate. So, but a lot of people, they use hard money and bridge loans to take them from point A to point B, and they'll pay more interest because it's an easier loan to get, like you're mentioning, and then they'll refinance and get off of it or sell that property. So it just depends. What I'm getting at, the point that I'm trying to make is it depends on what you're trying to do, and then we can see what's the best loan for you, because you might be able to qualify for that easy loan, but it may not be in your best interest to do that loan. But generally speaking, obviously private hard money loans are going to be easier to get, but it may not be the best loan for you, is what I'm trying to say. We have to do an application. We have a meeting together. We go over your file. We discuss it to see what can we do to make it work, right? What are the options? We got to go through it. We got to have that meeting, that call to kind of discuss the deal, and then we can see how to make it work. I'm doing good, Mike. Thank you. How are you? Thanks for reaching out, Mike. So, yeah. So anyway, we'd love to help you out any way that we can. Reach out to us, call us, text us, whatever we can do for you. Matt, what are the requirements for a hard money loan? Um, Man, cool. Thanks, Mike. It depends on what you're trying to do. I mean, the requirements can be the minimum loan amount's 100,000. I can say that. I mean, some hard money loans have a credit score requirement. Some don't. Some of them require 10% down. Some require 30% down. Some of them require that you close an LLC. Some require that you don't. Some require that you own a primary residence. Some don't. So it depends on what's your situation. I got to really meet with you and discuss it and figure out what you're trying to do, because you see, there's hundreds of products, right? And I have to see what you're trying to do to put it together, and it's called deal structuring. And in the deal structuring, um, when we assemble your file, that's where we really try to get underneath the hood to figure out what you're doing, and where you're trying to accomplish, and then attach that to the optimal loan product that's available in the marketplace. because the requirements vary greatly. It's not just plain Jane vanilla, black and white. They're all over the place. That's why, and I know that's not probably the answer that you want, but ultimately what it leads to is us having a conversation, going through it, doing an application. There's no fees to apply. You don't pay anything. There's no contract between us. Um, we don't do a hard check. Like I said, we just do a soft check on your credit, but then we can go through it to have a meaningful conversation to figure out what you're trying to do, and then work towards that, or give you a route, a map on how to get there. In the end, when you work with me, you're either going to get approved or you're going to get a map, a route on how to get approved for how to get approved for the loan. It's going to be two things. Either you're going to get approved right now, or you're going to get a route how to get approved. That's what you're going to. You're not going to get a loan denial from me. You get one or two things with Angelo. It's either approval now or a route to get it done. We don't do any loan denials. So, and that's another big thing on why to work with us versus somebody else. Most people, if you don't fit the bill, you're out. They don't return your calls. You get a loan denial in the mail, and you're done. We don't work like that. You need to get either an approval or a route, and that route is it's a map on how to get there. Yeah. Marco, if I buy an investment property on conventional loan, the future rents. That's right. Yeah, the rental income. When you buy a rental property, guys, the rental income goes towards the qualification. So, like if the rental income is $2,000 a month, okay, that gets plugged into the qualification. That's just it goes into your income calculation. Whatever that rental income is. That's exactly how it works. Oh, my cigar's out. Yeah, that's yeah, which is good. It helps you to qualify. So now a primary residence doesn't work like that, but the rental properties do. I mean, that's why I'm a big advocate. Yeah, well, because we've been down those roads, man. You know, dealing with a lot of these banks and mortgage companies, man. I'm going to tell you, it's a bunch of crap. I mean, if I had a penny for every time I got a call when a loan got denied, from a bank, and we had to come in and save it, I'd be richer than Elon Musk. Because it's so sad that, you know, I don't know. I don't know how these mortgage companies and lenders, how they, some of them, now, of course there's good ones out there, and we're not the only one that's good, but a lot of them suck. Reason why, they don't want to put in the effort. It's just like, I don't know if any of you guys, I'm sure in your career or sports, life comes down to, and business, comes down to a few things. I always tell my people it comes down to three things. It comes down to focus, effort, and attitude. Focus, effort, and attitude. You got to have these three things if you're going to be successful. So thanks, Matt. I appreciate that, man. So, you got to have the effort, whether you're a baseball player, basketball player, musician, artist, businessman, and you got to put forth the effort to get it done. And a lot of people, I'm telling you, they don't want to put in the effort. There is ways to get out of the lease, yes, but it depends on how much it is. There's lease buyout options. There's a reletting fee. There are ways to do it, but it depends on, obviously how much it is. If it's a couple $1,000s, you can probably make that work. If it's like 20 grand, that could be tough. Sometimes you got to talk to the landlord to see what you can do to make a deal. But there are ways to get out of a lease. So, and here's the thing: I'm not trying to say I'm perfect. We're not perfect. We make mistakes too. I'm not trying to say that at all. I'm just saying that I see that a lot of lenders. I'll give an example. I had a customer call me the other day. He said that he went to a bank. I'm not going to mention the lender's name, but basically, and this guy's got stellar credit income. They denied him because his debt ratio was 46% and it wasn't 45% for the loan guidelines, the requirement. And I couldn't believe what he told me. Like, he was 1% off and they denied his loan. Instead of trying to figure out how to make it work, how to do it, they just deny the loan. Now, I mean, how do you run a business like that? I mean, it blows my mind that you're not going to come back with a solution, a counter offer, a route, something to help somebody. They just, no, sorry, you're denied. You don't meet the requirements. I mean, if you run your business like that, I think you're going to go out of business. But maybe they got so many customers they don't care. I don't know. I just can't believe it. I just tell you, we'll never do that. So, anyway, um, if we can help you guys, don't be a stranger. Reach out, call us, text us. Thank you. Yeah, that's right. We do. We will go. We will dissect the file and figure it out. And I don't know if you did a loan with us or not, but we do that. We will go through the file and figure it out. Now, that doesn't mean that, um, you know, okay, like I said, it doesn't mean that you're going to get approved always right now. It may take a month. It may take 6 months. I don't know. Oh, you work with Mike Z? Okay. Yeah. So, um, you know, so that's the thing. We're going to go through it. Um, oh, it didn't go through? I didn't go through. Oh, okay. Well, reach back out to us if you're looking to do a deal. The market's getting really good again. You might find some good stuff out there. So, um, but yeah, I mean that's the bottom line. We will go through it and figure it out the best that we can. You know, and that's our commitment, our promise to you guys that we're gonna do whatever we can to figure it out to make it work. Like I said, we're not perfect. We do make mistakes, but we're gonna do our best to figure out a solution. So anyway, I appreciate all of you guys tuning in and watching the channel. Check out our TikTok, our Instagram, Facebook, YouTube, all of our social media to get more info. We have a lot of products on there that we discuss. And you can call or text our office. We're open 7 days a week for you, 832-431-6331. I appreciate all of you guys watching the show and the channel. Enjoy your spring break. Enjoy the time with your family or whatever you're doing. Yeah, reach out. Call us, Mike. Text 832-431-6331. We appreciate you guys for tuning in. So thank y'all so much. Take care. Have a good night. Stay strong. We love y'all. We'll see y'all again next week. Later. Bye-bye.